All right. Good evening, everyone. Thank you for joining us. My name is Adam Lendy from Beyonder Holdings. Really appreciate you taking some time out of your evening to meet with us tonight. I'm joined tonight by two of my team members, Don Spafford and Ramesh Nachapan. Don and Ramesh are both part of our investor relations team, here to help you out tonight. Of course, if you have any questions, you can message them directly or reach out. They've both got their contact information on their Zoom backgrounds. So they'd be happy to answer any questions you have or help you with any steps that you need moving forward with your investment decisions after this evening. Some of you, this may be your first exposure to Beyonder Holdings. Welcome. We're glad to have you here tonight. We'd love to share with you what we do, why we love the industry we're in so much, and some about the opportunity that we have tonight that we're working on together. It's been a very interesting market this year in all investment vehicles. Needless to say, we've experienced our own shifts and changes in our market as well too, but I am proud to say that I feel confident enough with where we're headed to continue this webinar tonight and tell you that I'm going to keep putting my money in this and show you why I like this so much. So let's dive right in. We'll get some of the legal stuff out of the way first. Of course, this is all visible. Don't feel like you have to read it now on our website. This is in our investor portal, but the lawyers, I'd be remiss if I didn't show it to you guys. Let's just say that. So the disclaimers, of course, this is an investment vehicle. There are risks involved with that. So please be sure you read those and understand those before you make any investment decisions. All right, so let's talk about the problem. And of course, you all might be seeing this if you're already experienced investors this year in different asset classes, is where are we finding good opportunities? It seems like the wells we've been tapping for the past few years, many of those have dried up. Either the opportunities aren't there, the deals are coming apart. There's a lot that's changed this year. It depends on what asset you're in. Some are way down right now. A lot of it's just touched by the volatility of the banking system, and a lot of different things have happened this year. There's a lot of reason to be fearful. And then there's a lot of reason to put that fear to the side and look objectively at things and decide, of course, if there is a right decision going forward. So what we do is we do things a little different. We are a real estate investment group. We believe in hard assets. We like, I've been a real estate investor for over a decade now. I like things that I can go out and touch and feel and see. And these are ones that you can do that with too, but our space, it's a little more fun. We can actually go out and take our family to them and touch them and feel them and enjoy a weekend there. It's one of the things we love about them, but of course, not the only thing. What got me into this and what got me excited about this space to begin with was just the opportunity you have in the outdoor hospitality space to generate massive cash flow. There are a lot of opportunities to improve revenues in this space, to really maximize the different ancillary income streams that you have available to you. This is an asset class that is heating up right now. I equate this to what multifamily was 15 years ago, what self-storage and mobile home were 10 years ago. This is one that has been primarily mom and pop until about just 3 or 4 years ago, when it started slowly becoming institutionalized. So I have a feeling this is going to follow the same trajectory over the next few years, and any early adopters who got in now are really going to reap the rewards of this. And then, of course, we've got some outstanding tax benefits as well in the space too. In fact, it's one of the things that we really love about this is that we can, in some cases, see more accelerated bonus depreciation in our asset class than you can in other real estate asset classes. It's not all the land like you might think it is. So just some of the things that we find that we like about the space so much. Let me talk a little bit to you about the industry. Like I mentioned, this is already a heavy mom and pop industry. I don't have exact data on this because unfortunately nobody to my knowledge is collecting this. But I will tell you from my anecdotal experience of calling campground owners to try to get them to sell us their campgrounds, I would say that roughly about 80 to 85% today are still mom and pop owned. Compare this to what mobile home was about 10 years ago. That number was even lower at that time. More of those were institutionalized at that time, and that space has condensed a lot. This is a $9 billion industry. This is not a small industry. Camping is a big space. There's 16,000 private campgrounds in the United States. That's excluding state and national park campgrounds. So we've got a very big market we're playing in. Some interesting figures on this too. And again, data that I don't have updates on because I can only work with the data I'm given, but the statistic from 2019, before the RV boom really took off and accelerated, was that there were about 2.5 recreational vehicles for every 1 RV site in the country. Think about that. If everyone in the country wanted to go out camping one weekend with their RVs, there would not have been enough sites for all of them. And that number of RVs has gone up drastically in the past 3 years. And yes, development has gone up as well too, but not even close to the pace. If I had to venture my best guess, I would say that number's risen above 3 RVs per every RV site in the country. So there's incredible demand for the limited RV sites we have out there at this time. So who we're looking for, of course, the people we want to go on our journey with us are people who are sophisticated investors. In fact, our current opportunity is limited just to accredited investors. Now, we do have opportunities at times for non-accredited investors, but for the scope of the fund that we have open right now, we did have to restrict this one to accredited investors only. But of course, we're looking for risk-tolerant investors, because even though I feel that this is a very safe asset, and I see that there's a lot of upward trajectory and a lot less downside than some other asset classes, this is still an alternative asset class. This is still a relatively young investment vehicle, which of course is why the returns are where they are, because I guarantee if this were seasoned like those other assets, we would not be able to offer, well, we wouldn't need to offer the returns that we do in this space. So we are, of course, looking for people who are risk tolerant, who are looking for something that maybe is not long-term tried and tested, but does have a very strong potential. So of course, experienced investors are going to be our top priority. But of course, if you are new to real estate investing, we'd love to have a conversation with you, help you decide if this is the right space for you, and just make sure that you're clear on what is involved in this course and what the trajectory looks like in this space. So again, this is a big growing space right now. We had 19 million new camping households between 2020 and 2022. That's the biggest growth in users that this space has ever had in the past. Now, there's always attrition in this space. Every year there's been a certain number of new campers that come in and a certain number that leave and a certain number that hang on. And the great thing is we had 19 plus million new campers in that 3-year segment, but the retention rate went up. So whereas before we were, I want to say it was low 70s, we were about 74% retention in 2021. So that's great news. More people who started camping said they were going to continue camping and keep doing it. Of course, 6.2 million of those households bought their new RVs in that time. That's what actually drove our industry crazy at the time. It put all the manufacturers in backlogs from 2020 and 2021, which they spent the entire year of 2022 trying to fill and catch up on. Even though that industry has seen a little bit of slowdown in sales, the number of new units that are out there and their current numbers are still above any years that they've ever had in the past prior to 2019. Of course, this is kind of a great number here. So the 32% figure up here on the screen has to do with the economy this year, and it also had to do with fuel prices last year. Fuel prices were something we saw as a substantial risk in our space last year. When the price of a gallon of gasoline crept up to $6 a gallon, diesel at one point was over $7 a gallon. And of course, we had to wonder at what point would people stop taking their RVs out? We didn't find that point. Unfortunately, well, I should say fortunately, we didn't have to find that point because what we ended up seeing, because we use software at our campgrounds that we do operate to understand where our users are coming from, what we saw is just different migration patterns. We saw a lot less over the road long distance travel. We saw was a lot more intrastate travel, people who were just going within 2 hours of their home. They want to get out and back on a tank of gas because it costs a lot. But the best part is we measure occupancy in our space, not vacancy like you might in some other real estate assets. And we saw our occupancy numbers remained about the same. But all we just changed is where they were coming from. More of them stayed closer to home. It really affirmed some of what we were doing. As we look into 2023 and the year ahead, airline prices have been up much higher than they were, of course, last year. And what we've seen, of course, with this number it refers to is the number of people who said they would replace those other forms of travel with RVing. They're saying, you know what, that trip to Europe, that can wait another year. We're just going to get out, we're going to go camping this summer. So that's what the 32% nods to. Also, of course, had to do with the softening economy that we started to experience at the end of last year. People, again, were saying, well, hey, I'm going to put that big trip on hold. We're just going to go out and go camping more this year. And of course, 64% of people surveyed, that was a 2022 number, said that they were going to camp more often in 2023. So just great statistics to show that this is one of the great American pastimes. This is something that people have no intentions of stopping, that they are going to continue doing as we go forward. All right, so what do we have that's different? There are a few other groups in our space. I'm not going to tell you that there aren't. We have other people who are competing with us in this space, and I use competing lightly because this is a very lightly saturated space. There are not a lot of us clamoring at these deals that are out there. But what does really set us apart is this. Just like those other real estate assets I mentioned before, this is competitive on the buy side when a property is listed with a broker. And what we've seen in the past year is the cap rates have compressed a lot. Actually, the past 2 years, they've compressed quite a bit. Whereas before we were seeing cap rates around the 12% range, last year they compressed down to about 8%. That's a massive compression, which is a huge increase in value. I'm proud to say, though, that we as a team have never offered on a property below a 9% cap rate. And in fact, we've got our numbers that we're underwriting with up right now. And a lot of this comes from us prospecting our own opportunities, that we do not rely on brokers, although we do network with brokers and we do look at their opportunities. We prefer to prospect and find our own off-market opportunities. In fact, we closed 2 properties last year just from our own prospecting efforts. And I'll give you a great update on one of those. One of the ones we closed was our property Beyonder Marine at Sterrett Creek. That's our RV campground and marina property in Missouri. We closed on that property for $6.2 million. We're refinancing it right now. And prior to our renovations that we're putting in, the appraised value was 7.3. And that was after 6 months. So just to let you know what the advantage of us doing our own prospecting do as it relates to the purchase price. So that's a big thing that we really hang our hat on. Of course, the other two is that we own our management company. We don't outsource our management. A couple of the other groups in our space do manage their own properties, but they have a very different model than ours. Nothing wrong with theirs, but we built a model that was scalable, because when we entered the space, we set a goal to buy 100 properties. And that was our plan, is that we were going to buy 100 properties, and we're still working toward that goal, but we knew we needed a model that could scale as the portfolio grew. We've spent the past 2.5 years perfecting that model, refining our systems, changing our roles. We've got a great remote management model in right now where we empower the managers on site at the properties that we're investing in to treat it like it's their own business. And they really, truly are invested in growing their business, growing their revenue, and keeping these properties valuable for us as we move forward. All right, so let me talk a little bit about the company, about Beyonder Holdings and who we are. So Beyonder Holdings, a relatively new name for us. You might know us from the past as Happy Camper Capital. When my partner Justin Hoggett and I started this company about 2.5 years ago, we formed a holding company called Happy Camper Capital, and we formed a management company called Beyonder Camp. And quite frankly, the best explanation I can give for why we operate under Beyonder Holdings now is because I got tired of explaining the difference between the two companies. I spent more time telling people what we did at Happy Camper and why it was different. So it seemed like a better unified front for us to have this one name together. But all that to say, Beyonder Holdings, we're committed to bringing exceptional outdoor hospitality investment opportunities to you to invest in. These are opportunities that we put our own money in. We like to say we put our money where our mouth is. We invest in all of our own opportunities. Everything that we've brought forward at this point, we've got very stringent acquisition criteria and underwriting criteria we look at to really provide maximum returns on this, and to, of course, build a wonderful portfolio of outdoor hospitality properties. So talk a little bit about our model. Like I said, we control the deal from end to end. So from acquisition through operation, throughout the entire phase of ownership, we control every bit of it. In fact, new for 2023, we added a construction and project manager. So we are no longer outsourcing any of our project management either as well too. That's something that's handled in-house to help us make sure that our capital improvements are on track. Of course, it's one more thing we do to make sure that we are maximizing what we can potentially do with these properties as we move forward. Talk a little bit about our history as a company. As soon as my computer catches up, it's getting a little tired here. Here we go. So 2020 is when Happy Camper Capital and Beyonder Camp were formed, as I mentioned, by Justin and I. We bought our first property. It was a 148 site campground in Oxford, Iowa, which is just outside of Iowa City. That we have dubbed Beyonder Getaway Sleepy Hollow. We bought our second property. Took us almost a year. It took us 11 months later. We learned a lot of lessons in that time. We tried to bite off more than we could chew on a couple of bigger deals along the way. But really spent a lot of that time actually perfecting our management systems on Sleepy Hollow before we acquired Beyonder Getaway Rising Sun in May of 2022. That property there has been one of our top performers in the time. Rising Sun, that is. It saw tremendous growth in just its first quarter of operation last year. And then, of course, we closed on 2 in the month of August. So that was Beyond a Marine at Starrett Creek. That was the property I was just telling you about that had a great appraisal come back. And then of course, Beyond Getaway Lazy Acres. So those were our third and fourth properties. And then in November 2022, not marked on here, but that's when we launched the Outdoor Hospitality Sun and Fund, which in December was able to make its first acquisition of Beyond a Resort Cajun Moon, which is just outside of Lake Charles, Louisiana. So that is the first property in the fund, which is the opportunity that we'll be sharing with you here tonight. So that's a little bit of background on us and our space and why we do what we do and why we like the space so much. I didn't mention this at the beginning, but I will just encourage you now. Of course, you're likely to have questions come up throughout this evening. We are going to open up for some questions at the end. So feel free to, if you want to put them in the chat for now, so you don't forget. We'll read them aloud and answer them, or if you just want to hold on to them, we'll have an opportunity at the end for you to unmute and share those. So let me dive in, and I want to talk to you about the Outdoor Hospitality Sun and Fund. The Outdoor Hospitality Sun and Fund is our current opportunity. As I mentioned, this is a fund which is open for accredited investors only. So let's dive in and talk about what the strategy is and, of course, why we are pursuing this goal. So those first properties I shared on our timeline, we did those in syndication format. So those were each what we call a one-off syndication, meaning that we formed a limited liability company for each one of those properties we bought. And we raised the capital we needed to buy that property and to do the improvements on that property. And then we closed it and we bought the property and we operated. Well, what we found is a few things. So the feedback we've gotten on our first properties is this: people are happy with the properties, the way they're performing, but they don't like some of the seasonality in this, because one thing we'll mention is that this is an outdoor hospitality asset. Unlike, say, multifamily, which has year-round rents coming in every single month, we get an overwhelming majority of our revenue in 2 quarters of the year, typically. So what we ended up with is large distributions in 2 quarters of the year and much smaller distributions in the other 2 quarters of the year. Of course, we have a lot of investors who are trying to budget their income and their spending on this. So we were mindful of that being one concern that came up. The concern we had is that we found we couldn't be as competitive as we wanted to be, even though we were making great offers and getting some good deals under contract. We weren't able to go in and close as quickly as we'd like to, as if, say, we had money from a fund on hand that we could purchase property with and then refinance it. So that was another goal of the fund. A couple other things we were looking at too is we did have a lot of new investors who were coming into the space, who are new to this asset class, who wanted to see a little bit more diversification. They felt a little bit better if they had more than one property, and so their single investment could go into multiple assets at the same time. Provides a little bit of hedge against maybe a natural disaster or a change in seasonality. Being in multiple markets not only allowed us to even out the seasonality of cash flow humps by having properties in the southern states that have a prime season between April and November, and then of course in the northern states, I'm sorry, other way around. Southern states which have a prime season from November to April, and the northern states which had prime season from May to October. So it did blend a lot of that out, of course, provided some diversification along the way too. So it was really a win-win in that format. Also, again, considering the fact that we could, if we had the right opportunities come up, make a very enticing offer to a seller to buy something potentially well below market if we were able to close quickly and close with cash with them, which we do have the due diligence systems in place to be able to do, provided we get the fund to the right numbers. One of the goals of this fund is to acquire what we call blue chip properties. Because I mentioned, of course, this is a relatively young investment asset class, we could take some very bold risks in this space. We've chosen with this asset not to do these. And instead what we're doing is we're looking at properties that have a reliable track record of producing cash flow, but that still have meat on the bone, meaning it has an opportunity to expand, to increase the number of sites on more acres, to add ancillary revenue streams in. Perhaps we've got a very strong market and we're able to see that this business has been mismanaged. There are a lot of things that we look at the properties that we put into the fund, or that I should say we put into any of our vehicles. And of course, these ones here, like I said, for this fund in particular, for the Outdoor Hospitality Sun Fund, we were not looking to take any very bold risks. The idea is, because we didn't have the assets picked yet, we did have to give confidence to the investor that we were going to pick properties that they felt comfortable putting their money in, even though they had not yet been purchased. Now, I will mention we do have one property in the fund already, which I'll share with you shortly. Of course, we gave a little bit of a preview on a minute ago. Of course, like I mentioned already, this is the opportunity to take one single investment and spread it across, when the fund is completed, likely 6 to 8 properties that will be in it at that time, as opposed to just being in one fund. I already mentioned this before as well too, but one thing we're doing that is helping us not only keep on track with our schedule and our spending is moving our construction management in-house. So we have a gentleman on the team who's dedicated to overseeing our project implementation, any of the expansions that we're doing. And then of course, one of the big benefits being that Beyond Our Camp is managing the entire portfolio. So we do have our in-house management system in place, which saves a tremendous amount of money over us outsourcing that management to a third-party company. So some of the things we look at when we go in to a project on how we can optimize that business. I already gave a little bit of a hint to it as I spoke about expansion and adding other ancillary revenue streams, but we have a linear track that we tend to follow from day one closing day to year 2 when we get a property ready to be stabilized. So when we start off in a project, the lowest hanging fruit for us in this space is the revenue optimization. So again, this is an asset class where we're looking for destination vacation properties, places that you'd want to go spend a weekend or a week, maybe a couple of weeks, but typically those are our primary users we're looking for, not so much the long-term tenants. And the reason for that, of course, being that we can make a lot more money off of a site if it gets turned over more often on a nightly or weekly basis than we could on somebody who's there on a monthly or annual lease basis. So of course, that is our preference to be in that space. We use specialized software, much like the hotel industry uses, to optimize our revenue. We do market research to understand what the rates are in an area. And then, of course, when we put a software program in place that will adjust the rates based upon the occupancy of the campground and how much demand there is to help us maximize revenue. This is a major improvement over what the mom and pops were doing and what a lot of them still are doing today, where they have all their reservations in a ledger pad or on a calendar on the wall, and they have one fixed rate every single night of the week. And they're proud of having 100% occupancy on the weekends. But of course, 100% occupancy means that they're leaving a lot of money on the table, especially if it's at a fixed rate. So that's one thing we do right away. It's been part of our business plan. It's a very low cost, low time activity to put in to really boost the revenue. The second thing we look at doing is how we can expand the number of rental units. So now we begin filling that occupancy or maximizing the rates for it. Now we need to find out how we can multiply that. So some of this comes from if there's maybe unused acreage on the land we're already buying, that's an opportunity for us to add more sites or different accommodations like cabins and glamping units, different things that depending on what the demand is in that particular campground. It's an opportunity to acquire additional land. Maybe there's an adjacent piece of property, a farmer that wants to sell some acreage to the side, and we can look at an expansion opportunity there. Sometimes it's repurposing existing accommodations. A great example of this might be a campground where tent camping isn't in high demand, but there's an opportunity to put cabins in. So we can build cabins on existing tent sites. So that can be a great use as well too. Of course, depending on the market, glamping and cabins, they can kind of go interchangeably. It just depends on where you are. For those of you who are not familiar with the term glamping, it combines glamorous and camping. So if you haven't seen these units, they're very cool. You can go Google the term after you get off this here tonight. Typically, it's unique accommodations. So big canvas tents or yurts or covered wagons that are decked out, have really nice furniture in them. Millennials typically are our primary users, and Gen Z who like to get that Instagram moment of them camping in these really unique stays, and they pay a lot of money to stay in them. So glamping is a great opportunity as well too. We look at how we can improve our different revenue generators. So we have direct and indirect revenue generators. So these are going to be things like rental golf carts, arcades, liquor sales, and anything we can do to improve the camp store or to add other income streams through restaurants. These are great direct driving revenue generators, things that you can see on the line item, on the balance, or I should say on the financial statement, where that income's coming from. And of course, the other thing we also look at, we take a balanced approach and we look at indirect revenue generators, the things that maybe don't have a dollar amount of income tied directly to them, but because you have them, allow you to justify higher nightly rates. So these are things like aqua parks, swimming pools if you don't have them, pickleball courts, fun things that are going to bring people in and not only make them want to pay more to stay there each night, but also make them want to stay there additional nights. So those are the indirect revenue generators we look at. And of course, we talked about the income side. Now we got to talk about the other side, which is the expenses. Of course, how we keep those down. This is one of the big benefits that Beyond Our Camp has over doing a one-off management platform at each campground, is that we have the ability to combine a lot of our purchasing. We have corporate purchasing accounts with some of our vendors that get us special discounts where we can do bulk ordering. Of course, we have our managers are they are put in charge of their campgrounds. As I mentioned, they treat it as though they own it. And I'm really proud of this because this is part of our bonus model we have built with our managers to actually incentivize them to treat the campground like they are in ownership of it. They're bonused on their revenue and they are bonused on their expense ratio. So they have every incentive in the world with an uncapped bonus to drive the revenue as high as they can, because when they get above their budget, they get a small incremental bump every single time they hit a threshold along the way, and it's uncapped. They can keep producing as much revenue as they want, and their bonus will keep going up. We have an expense ratio bonus for them as well too, that when they hit it, gets them in. And then of course, as they drive their expense ratio down lower and lower, of course, that bonus keeps going up for them as well too. So directly putting money in their pocket, you could almost call it a profit share program. But what we found is they're very mindful of their overtime. They're very mindful of spending on certain things. They make sure that they get 3 quotes on every single project that they get done, and pick, not necessarily the cheapest one, but certainly the one of the best value when we have a repair or an upgrade that is going to be done. So these are some of the things that we do to, of course, help keep the expenses low in the campground, in addition to actually having our CFO spend monthly budget calls with each manager to go through their P&Ls with them to review their performance and give them suggestions going forward. And then the last benefit, of course, as we're talking about money, is our tax benefits, of course. So we do cost segregation studies on every one of our properties, which, if you're not familiar with the term, is a way of determining which assets on the property can be depreciated faster. And then we take a bonus depreciation in year 1 as a percentage of that. And what we've found is some really tremendous results. I'd say on average, all of our campgrounds, we were able to get a depreciation for their bonus depreciation was in the 70 to 80% range for year 1, 70 to 80% of the purchase price. So just a tremendous amount of depreciation that came back out of it. In addition, of course, the remaining ongoing depreciation from the business for the next 39 years divided out. So really absolute great benefit. Another great benefit too is, of course, when you exit this, which I didn't mention on here, is you have the opportunity to take your investment out via 1031 exchange to put in another real estate investment going forward and potentially defer your capital gains on that as well too. All right, so let's talk a little bit about the Outdoor Hospitality Summon Fund, the nuts and bolts, how it works. We'll go through some of the numbers on it. Then I'll show you the opportunity that we have that's in there right now. We are working toward other opportunities to add in. They do have to meet a very specific acquisition criteria, which I will share with you shortly. But the fund is structured. I did mention, of course, it's raising $25 million. I'll have more details on that on the next slide. But we are looking at an ownership structure of 65%, 35%, meaning that where it says fund on here, that would be also, you can call limited partners. So the silent investors who come in and invest alongside us retain 65% ownership. We have 3 share classes on this. And this is one of the things I'm most excited about, is that depending on how much you invest, you hit either a class C, B, or A share, and you get to pick your preferred rate of return. So for those who come in at our minimum, which is $100,000, up to our class B, which is $250,000, they get an 8% preferred rate of return, which is great. But for those who then go from 250 to 500,000, we would bump that preferred return up to a 9%. And then, of course, anyone who comes in with 500,000 or more is going to get a 10% preferred return. We have an adjusting IRR on here, and part of that is just to help keep the delineation between those 3 preferred returns. We can explain that more offline. It's probably more complicated. That I'd have to get a whiteboard out right now to show, why that's important, but why it's beneficial, of course, for the Class A to have that higher IRR threshold for where the ownership of the assets above that shelf switch over to 50-50. We do evaluate for quarterly distributions, and because this is a multi-property fund, after each property has been held by the fund for 1 full fiscal quarter is when we will evaluate for its first distribution. So meaning that the property in Louisiana that's in the fund right now, in fact, we closed on it in December 2022, meaning that if we did not evaluate it for distribution in 2022, however, it has been in our holding now for the first full quarter of 2023, and we are evaluating for that right now as we are looking to close out Q1 and get distributions out here in the next few weeks. The sponsor acquisition fee on this, you'll see there's a range, as is with the loan and financing fee. This is in part because we adjust our fees based upon the purchase price. We don't like to keep it fixed in one place. If it's a much larger property, we'll actually lower that fee down. Whereas if it's a smaller property, we actually have more costs we've got to cover, because it costs about the same amount of money to close a property, whether it's a small one or a big one. It might be on the higher end. To give you an idea, the property in there right now was a $7.2 million purchase, and we were right in the middle of that range at 3%. We have an ongoing asset management fee for the fund of 2.5% of the effective gross income, meaning actually where this differs from other funds, it's not based on how much money is in the fund, it's based on how much money the businesses generate within it. So we are directly incentivizing this on the performance of the business, as is the property management fee, which goes to Beyonder Camp for property management at 7.5%. Of the effective gross income, same thing, which is just the top line revenue minus the cost of goods sold. So that's the income before expenses. And then, of course, we have a loan and financing fee, otherwise known as a guarantee fee, that ranges 1% to 2%, again, depending on the size of the debt that we are taking on. So those are the top line terms of the fund. I'll talk a little bit about some of the other numbers on here as well, too. Again, as I mentioned, this is a $25 million of equity fund, meaning that we're raising $25 million of investor equity, which we are going to couple with bank loans. And also, to cover the purchase and also the construction on. We are expecting this to yield about a $75 million portfolio, including the real estate and the improvements on it at their purchase time. We are projecting a cumulative IRR north of 20%. You can enter this with a $100,000 minimum investment. As I mentioned, of course, those shares go up. Actually, let me go back real quick and mention something I forgot to share on this. This is probably one of my favorite things about this share class structure. So that class C, B, and A share, this is something that I don't know any other sponsor who does, but we allow you to level that share up, and not just level up the shares above it, but level all of your shares up. And I'll give you a great example would be if you came in with a $150,000 investment at the beginning, you would be in a class C share. But let's suppose 3 months in, because this fund is raising through November of 2023, you added another $150,000 to it, bringing your cumulative up to $300,000. All $300,000 of your investment is now bumped up to a Class B share. Not the part below, not the part added in the second tranche. Every single share is leveled up to a Class B share. Now we get to October, and you decide you're going to throw another $200,000 in. It's been a good year. You bring your entire investment up to $500,000. Every single share of that investment is at $500,000. Now let's fast forward 5 years down the road. The fund's performing well. We do a big cash out refinance, a big return of capital to the investors. We return $200,000 of your capital to you. We don't downgrade your share at that time to a Class B share. All of your remaining shares remain at that Class A. So that's a big thing. So we're going to keep you leveled up to wherever you go. It's like a ratchet. We're going to ratchet you up, but we're not going to bring you back down. So that's just something to share on that. Move back forward here. Okay, the projected life of the fund is going to be 8 years total. And the reason it's 8 years, it seems like a strange number, is that we do each of our holds, we have a planned 5-year business plan. So we launched the fund in November of 2022. The plan is, of course, to do our closing on the raise November 2023, meaning that we have a year to raise the money into the fund. We're then giving ourselves a year to deploy that capital from the fund to make the purchases of all the assets, which at that point will put us 2 years in. Given that we need a 5-year cycle to put the improvements in place to stabilize the business and get the income to where we need it prior to liquidating each asset, that could take us up to potentially 7 years, giving us a year at that point, of course, to liquidate and wind up the fund. So we're looking at this as a maximum of 8 years. There's a great chance that if we hit our goals sooner, and of course, with the vote of the investor members who come along with us, we could achieve those goals and wind up sooner. But the plan right now is that this could be a maximum of 8-year investment for investors to come in. As I mentioned, this opportunity is for accredited investors only. We are projecting, and this is just because this is based on investment by investment case, that we will likely end up with a 2.5x or greater equity multiple as you come in, meaning that we would target to take your initial investment and multiply it by at least 2.5 times by the time we come out. Our share prices, this is the big differentiator, because of course I get the question, which is, well, why wouldn't I just wait until November 2023 to put my investment in once you got a couple properties in there and I can see how you've been doing for a little while? I can tell you we had a really great quarter, the first quarter for Beyond a Resort Cajun Moon, which is the first property in there. In fact, I got to see the preliminary March numbers. We more than doubled what we expected to do for revenue in just the month of March. So, based upon the performance, we're going to be evaluating the share price of the fund on a quarterly basis. So it is still $1 per share right now. However, as we close out the first quarter here and begin moving into quarter two, we are going to be reevaluating that share price, and it has a great chance that it's going to be going up here, and we will be reevaluating it quarterly until the fund closes November 2023. So you may have more buying power today than you will have a month from now and 6 months from now. So those are the top line numbers on it. Of course, because we only have one property in, I will share what some of our acquisition criteria are so you can know what we're putting in. Again, like I said, we put our own money in. We want to make sure that we're investing right alongside you. We want to make sure that we continue to bring great properties in. So some of the things that we look at when we buy properties, we are not just buying anything we can get out in front of, because believe me, we step over a lot more opportunities that come across our plates than we actually write offers on. So we have the ability, because we have such a large pipeline, to be picky about what we bring in. And I will say at a bare minimum, we won't buy anything less than 100 rental units, meaning RV sites, motel rooms, glamping units, cabins, different things that make a combination of a hospitality property. It's just really infeasible for our management model to run at less than 100 properties. So 100 is our bare minimum. We actually prefer 100 plus with an opportunity to expand. When we do our initial underwriting, we look to have a 12% cash on cash average per property as a minimum. So this is the property standing on its own, not necessarily needing to have the CapEx plan implemented. This is us going in and optimizing the revenue, optimizing some of the ancillary revenue streams, because sometimes we can't, it's not always easy for us to, I should say this, we expect to achieve that goal without needing the additional expansions. Obviously we're looking to surpass that with any expansions that we do. So some of the opportunities that we look for in the properties, as I've alluded to already, is of course the ability to expand, the ability to add revenue. We don't buy properties that are fully stabilized already. Those might be institutional class assets that a big hedge fund might want to roll up, where they don't have to take these risks as they see it. But we want properties that have that meat on the bone, that are going to give us that torque to hit that equity multiple we're looking to achieve in the next few years. Some of the things that we want is, again, these are vacation destination properties. We want amenities. We want fun things to do. We are not running trailer parks. These are fun places that people want to come, take their families, take their kids, go work for a week, and spend some time at. So water amenities. In fact, we just did a survey of all of our campers, and an overwhelming number told us that water was the most important thing, be that a lake, a river, a pond, a swimming pool, splash pad. They let us know that water is important. So we of course always look for properties on the water or where we have the ability to add water in. So those and other fun amenities, these things that help us drive revenues as well too, are important. Locations, I already hinted to this when I talked about fuel prices. We look for properties that are within 150 miles of a major metropolitan service area. We prefer actually having more than one MSA per property. And when we evaluate these, we're looking for growing communities that aren't just in one industry, like coal mining, for example, or everybody works in tech. We like to see growing communities that have multiple industries that support that community, and we want them to be within very close distance to our properties. This helps us not only for users, especially if fuel prices stay high or go up again. It helps us with staffing the campgrounds, getting the staff we need, the vendors, the contractors, anybody we need to run the campground. Having a great campground in the middle of nowhere can be really tough getting people. So that's a critical one for us, is the location. And then this is a big one for us that I look at it, as interest rates have risen a lot in the past year. The first thing I will mention is that we only typically look for fixed rate loans. So we are not buying properties with adjustable rate loans. We are looking for long-term loans. Typically 5 years is the minimum term we will look at. Looking at something that will potentially last the planned life cycle of ownership, if not longer. 5 to 7 years is our preferred late range on that. But a big thing we are underwriting now for is a debt service coverage ratio greater of 1.8. And just to give you the idea of what that means, if you're not familiar with the term, a debt service coverage ratio of 1 means that the money left over after you run the business would be just enough to pay your mortgage, and there'd be nothing left. So of course, we want to see north of that. Most banks will require it to be at least 1.3. We have an internal policy that 1.8 is about the floor for us. So we want to make sure there's enough money left over after we paid the bank to pay ourselves, and of course, put a good reserve away while we're at it to help keep the business stable and more solvent as we go forward. So let's talk about the property that's in. So this is the property that closed into the fund in December. This is Beyond a Resort Cajun Moon, Sulphur, Louisiana. This is near Lake Charles, Louisiana, which is a big vacation destination. We closed December 14th. Purchase price was $7.2 million. This is 118 RV sites, 32 motel rooms. There are opportunities in place to expand the property, and there are an abundance of ancillary revenue streams that were left on the table in this one here. Namely, this property had a great lazy river, adult pool, kids pool, had a great community room with a bar and kitchen in it right by the adult pool that was not being capitalized. We're actually putting a bar in there right now, which from our experience on other properties is a massive revenue driver. They had no camp store. We're adding camp stores in, and of course, they didn't even have online reservations. Beautiful property like this had no online reservations. So we know from our experience that that increases revenue. And like I mentioned, we had these numbers aren't official yet, so I can't speak with exact figures, but our CFO just sent around the preliminary March numbers, and we doubled our revenue goal for March. So absolutely crushed it. Great property. This is the reason I'm suggesting that if you are looking at this fund now, you might want to look and make a decision sooner than later, because I do expect that we will be raising the share price here very soon. So just something to keep in the back of your mind. As we move forward, let's talk about the exit, of course, because this question comes up, and I did explain this a little bit. As I mentioned, of course, each property that we put in will have a planned 5-year hold. Each property will be its own asset within the fund, held by the fund, with a planned liquidation after 5 years and a wind up of the fund after 8 years. Of course, if we're able to achieve our goals sooner, then we can look at making sooner exits on the properties within, and even potentially the fund as a whole. A great thing I want to mention about this, though, is the way we've got our PPM structured is that this is not a decision we can make on our own. It actually requires a vote of 75% of the investor members. So we will not be coming in and saying, hey, guess what, we're selling everything, guys. We will come in and say, we think it's a good idea to sell because we've achieved our goals and we've got a great offer, whatever the case is, and there's an opportunity to leave sooner. But certainly it will still require a majority vote of investor members. One opportunity we have is that we, the managers, would like to be considered for an opportunity to buy the properties at the end of the hold period. This could be something that could actually provide a great opportunity if, say, we had an economic shift and maybe the demand had changed, is that we could be a buyer in a market where there may not be buyers, although I don't anticipate that being the issue. What we would say, though, of course, because to avoid any conflict of interest, is that we would bring in a third-party appraiser at that time, if that were the case, and make an offer which the investor members can either choose to accept or choose to tell us that they prefer to go to market instead to see if they can maximize their sales. So that's going to be the opportunity we are looking at the end of each cycle on each property. Okay, and of course, more details about that on the website. I want to introduce you to the team, and then we'll get to questions here shortly. So of course, I've already introduced you to Ramesh Nachapan, Investor Relations. Bradley Claudianos is one of our acquisition specialists. He actually is the one who found Beyonder Resort Cajun Moon. Chad Swenson is our construction and project director. He's the gentleman I mentioned, of course, is responsible for keeping our project management in-house and really accelerating the timeline on a lot of the projects we've been putting in place while keeping them extraordinarily well within budget. And then, of course, April Hester's our executive assistant. She's the one helping keeping the wheels on at the corporate side here. And as we have a lot of plates spinning and a lot moving. I'm Adam Lendy, of course, as you know. I just realized we've got Justin and Don switched. I apologize for the head switch, but I promise that the gentleman you see in the room, Don Spafford, is not Justin Hoggett, but Justin Hoggett is my partner who launched the business with. Don Spafford, of course, is one of our partners as well, too. And then, of course, Rick Liebman, our CFO. Contact information on the screen. You can, of course, as I mentioned, if you want to speak with Don or Ramesh directly, you can reach out to them through the chat or get their contact information from their Zoom backgrounds. If you'd like to join our investor portal, if you have not already seen the investor portal, I've highlighted, you can go to investors.beyondercamp.com. Fill out a very short form. We'll reach out to you, just verify a couple of questions, and then we'll give you access so you can see the fund, see the current opportunities, see some of our updates that we've had on other properties to see how we're performing. You can check us out, try before you buy. But we've got about 10 minutes left. I promised I was going to leave some time for some questions. Don, do you mind let me know what questions we have in the chat?
Yeah. Again, thanks, Adam, for the great presentation. And again, thanks everybody for being here with us. Feel free, obviously, if you want to add more questions to the chat or unmute yourself to ask a question. So we do have a couple there right now. First one kind of regarding the leveling up of shares. So does the leveling up happen if funds come from the same household, but two different individuals, say husband and wife? Which I know is a situation we've had already in the past with an individual investor with two different entities. I'll let you answer, Adam, but I'll say I say it would probably depend on the situation. We have to analyze the time if it's. But it's a possibility that we could be done. We may have to analyze again, a case-by-case basis, depending on the situation, and kind of follow the advice of the legal team on that. But Adam, do you have anything else to add to that?
I would say it's a good question. And the case Don is talking about specifically, we had one investor who had a personal investment they wanted to make and also investment from a self-directed IRA. So it was the same person, just two different, it had to be two different investments because of the sources. We granted an exception in that case to level that investor up to a Class B share. But the big thing for us that we look at is the keeping, and the reason we have a minimum on this, of course, is because the investor relations component is a very big investment of time. We take you, our investors, very seriously. We want to make sure that we have enough time for you all. And if we were to, say, for example, allow too many small investments in, it would divide the time that we're allowed to spend with our investors. So we do look to keep that chunk down. I will say if it's the same household, significant others, maybe even, perhaps kids coming in with, we'd have to look at it on a case by case. I would say, I think it's going to depend on how many investors and the size of those investments that come in. But if they all at least reach the minimum, we could probably be swayed.
Okay. Then regarding the share price, would the re-evaluation of share price change the returns projected?
Yes, it would. So with the share price changing, because of course the equity multiple that we are showing is based upon today's share price. So if the share price goes up per unit, it will change that amount.
Yeah. I'd say if you want to compare that to, like, say, just the stocks, if you invest in ABC stock, 2 years ago at a share price of $5 a share, you invested in it today, it's maybe $10 a share. So you're investing in the same company, you're still getting the same dividend return per se, but your overall growth will be different as that continues to grow in the end. Okay, another question is, can you invest with retirement funds, solo 401k, SDRA? And do you know if this fund would fall under business participation and the subject to UBIT taxes?
You want to take that, Don?
Yeah, so yes, we can accept self-directed funds, 401k or SDRA. And again, I'm not giving legal or tax advice here. So talk to your CPA or tax advisor on that. But for UBIT taxes, I don't think there is a way to avoid that unless maybe use like an EQRP or some other structure that's set up to not have that added on there.
And if you want a referral on that, reach out to Don. He's got a guy you can connect with.
Yeah, Don, I would like to add solo 401k doesn't have UBIT taxes yet.
We'll give you our general disclaimer, though, that we are not
we're not tax
accredited. Check with your professionals before you make any investment decisions.
Yeah, exactly. And I would also want to add on the previous questions, right? That even though the share prices are going to change, it's not going to be drastic that would impact the returns like big time overall. Like it's not going to be like 2.5 is going to come down to 1.5 because of this 1 year, changes. It's right. So, it might be impacted for sure, but, it'll not be a completely, drastic changes.
Well, let's just say maybe we'll see how quarter 2 goes.
I know.
All right, any other questions we had come in? Anybody who has a question who didn't put it in the chat, you're welcome to come off mute. We're happy to entertain some. Okay, outstanding. Well, of course, if you have any other questions that come up after today, again, please jot down Don or Ramesh's information. Reach out to them with those questions. If you're ready to start investing, copy either the phone number, email down, let us know, or just jump directly on the investor portal, investors.beyondercamp.com. Get signed up, take a look at what we've got in there. You'll be able to see the performance, again, like I said, of our other assets. You'll be able to see what's in the fund in greater detail. We've got the full underwriting for Cajun Moon, since you would be investing in that, investing in the fund with us. And of course, if there's anything we can do to support you, please let us know. We're really grateful for you spending your evening with us and taking this time out to review this opportunity. And we look forward to having you as partners on this opportunity and others upcoming forward.
Before I say thank you everyone for joining, and we also working on the land right next to that Cajun Moon right now. So that is one of the requirements for the funds coming in on a regular basis. We make sure we are approaching all the development and everything else for Cajun Moon. And as Adam said, we're also actively engaged in new projects, new opportunities all the time. But as long as it pencils out the defined criteria, probably we will be moving forward as soon as we have the funds here.
And I'm going to end on an ask. I'm going to share the recording with everyone tomorrow. It will be out in the morning, so you'll be able to get that in case you came late, in case you had to step out and you missed any part of this in between. But if you get it, and if overnight you've thought of anybody in your life who could benefit from this, somebody who you know who's already investing, please forward it to them and share it with them. You never know what opportunity you might be helping them out with and helping them achieve. So thank you so much. Don, did you have something in closing?
Just going to add to what Ramesh was saying, that we have several LOIs that are out right now on a few properties. So very much high potential of getting something else in the fund very soon.
That's right. We're actively visiting them. I'm flying out tomorrow to look at one that could be a potential candidate. So, all right. Well, thank you everyone for joining us this evening. Have a wonderful evening, and we look forward to chatting with you soon.
Thank
Hi,
you.
everybody.